Keith says, if PCE numbers come out bad, will it affect the markets? Yes, it will. That's why tomorrow is going to be a very important piece of data. Right. So tomorrow, this PCE data, and PCE is important because the PCE number is what the Fed really watches and pays the most attention to. So I'm looking at 4.6 is the number for your core PCE number. If that number comes in high, if you come in at like 4.7 or 4.8, that the market's going to absolutely hate that. And the reason why the market's going to hate that is because that will immediately send the probability of a rate hike in June up. So right now the market has priced in a pause at the June Fed meeting, right? There's about a 65% likelihood of a pause at the June meeting. Now, the data that you got today actually ticked the chances of the hike higher. We were at like 15% chance. Now we're at about a 35% chance. And that's because retail spending was higher than expected. Jobless claims were much lower than expected. And GDP was, for the first quarter, this is the second read. So the GDP numbers get adjusted as time goes on. So first quarter, we got the first quarter GDP the other month. It was 1.1. They revised that number. You got the second read for the first quarter GDP. They said it was 1.3. So GDP was higher than expected. Jobless claims are lower than expected. Retail data, higher. Retail sales higher than expected. Retail spending higher than expected. So that all of that information goes into the soft landing bucket, right? That would be, okay, look, that looks like you're going to have a soft landing. But what that does is also then leads to the possibility of the Fed maybe thinking we might need to raise rates one more time, or maybe we have to continue to raise rates. Maybe we're not at that point yet. The economy is not slowing down enough. The labor market is still way too tight. Inflation maybe does not come down as fast as they thought. Inflation has been cooperating very, very nicely over the last several months. It's come down for 10 consecutive months in a row. But it's a lot easier for inflation to go from 9% to 4% than it is to go from 4% to 2%. That 4 to 2 is going to be a real pain in the ass. All right. The 4 to 2 is going to be a real pain in the ass. So now that you're getting down into like the 4s, 5, you still want to make sure that inflation continues coming down. If it starts to stale out, starts to get stagnant, and maybe you get numbers that are higher than expected, that's going to make the markets think the Fed is going to continue to raise rates. They're not done. They might raise again in June. Maybe they raise again in July. And that's going to start to put pressure on the markets because right now the market thinks the Fed is going to pause.